Now, I have two challenges. One is to explain some things which are quite technical in a simpler way as possible, and also to do that in a short amount of time. So I'll go right to it. So first of all, again, welcome. My presentation today is intended to provide some background for this Solvency II event and the discussions we'll be having throughout the course of the day. As part of our preparation for today's event, we ran a survey. In my presentation, I'll be sharing with you some of the positive feedback we got from that survey, but also be highlighting some of the areas where improvements were highlighted as being needed as part of the two reviews. I will also explain our concerns over the excessive capital for long-term business and use two case studies to help illustrate this. And I will finish by mentioning the two solvency reviews that Michaela referred to. However, let's just recap on the rather long journey from the launch of the project by the Commission to in about the year 2000 to the application of Solvency II at the start of 2016. We should also note that the journey is not over. So in fact, we've been operating under Solvency II now for 2.5 years, and already we've seen some improvements under the CMU project, and we have the reviews coming up over the coming years, one of which is due to finish this year. So ensuring Solvency II works as intended and fulfills its potential remains work in progress. But if we look back a moment, it's also worthwhile recognizing what a huge implementation challenge Solvency II involved for the industry, but also for supervisors and indeed EIOPA. I think, first of all, this was a revolution, not an evolution. It was really a big bang set of changes. And to be honest, maybe if we had to do it all again, we would have done it in maybe a phased way. It involved 3,000 companies with 10 trillion of assets. It meant companies had to introduce sophisticated modeling. Even those using standard formula, they still had to introduce significant data improvements and modeling of cash flows and valuation systems. We have over 180 reporting templates and 3,500 pages of text to implement. However, I think it was generally recognized that Solvency II was a successful implementation for the industry. And this was not by chance. First of all, we had an industry that was very strongly capitalized to begin with. We had an industry where risk management was already a core focus, and there was already widespread development of enterprise risk management systems and economic capital models on which Solvency II is based. We also had significant years of preparation, helped by many of the quantitative impact studies, also a huge effort by industry, national supervisors and EIOPA, and of course a huge investment. And of course that investment is not just the start investment, it's an ongoing investment that's involved. But this has led us to, I think, what can be reasonably called a world-class framework. And I'll be talking about some of the improvements, but I think we often focus on those improvements and sometimes forget to recognize how many strong features there are within Solvency II. And these are the features that make Solvency II strong, give it such potential, and are the basis on which the industry supported the development of Solvency II throughout and still as the right framework for Europe. So we have the 3 pillars. We have group and solo measures, economic valuation of assets and liabilities, best estimate of liabilities. We have many risks, all the risks covered. We have a scenario-based approach in order to measure the risks. We have internal models. We have 2 levels of capital. We have a strong and clear level of protection, and we had significant testing and transitional measures. I don't have time to go through all of these, but it's worth mentioning maybe just one of them. For example, the use of scenarios to determine the capital requirement for most risks. These are basically stress tests and are key because this approach can capture the impact of risk on the assets, on the liability, on the interaction between assets and liabilities, as well as capturing risk mitigation such as reinsurance, hedging and other risk mitigations. So this, for example, is just one of the key features that allows Solvency II to be truly risk-based, risk-sensitive, and capture the economic reality of our business. However, as I mentioned, there are some improvements, and of course we will be talking about those in more detail. I think first, and that's one we hear a lot about and we'll be talking about more today, is the need for better recognition of our long-term business model. We also have a system which is extremely heavy in terms of reporting, in terms of requirements. And the proportionality, which was meant to be helping with all that, especially with smaller companies, just isn't working yet as it should do. And finally, of course, we have the various specific technical issues, some of which are going to be covered now, some of it maybe need to be covered later, and others which will arise over time, and they also need to be improved. So the gentleman there is representing the industry, waiting for the reviews to get these issues up to the same level as the rest of Solvency II. But now let me move on to the impact survey that we did. This covered 17 member states and 87 companies. So while not statistically representative, it certainly gives us a sense of what companies are thinking and what they're doing. I think the first thing we did was ask about a range of potential positive impacts from Solvency II, and we received some very positive feedback. For example, every respondent agreed that risk management and governance, which are at the heart of Solvency II, had been improved by Solvency II, and almost all identified data quality as also having been improved, and a range of other benefits. So it is clear from this that many of the objectives of Solvency II are being achieved. However, we also identified some unintended consequences. For example, 58% of those that have long-term business identified Solvency II as contributing to a negative impact. We also were told by the respondees that nearly half of them invested less optimally in the real economy due to Solvency II capital requirements. And that includes in assets such as equity, property, in securitizations, etc. And when we asked them to give some flavor to that, and with some comments, they gave some sense of what was happening and why. And the general message we got was this a confirmation of the concerns that Solvency II is contributing to pushing the industry away from long-term business towards more short-term type products, particularly because of overall capital requirements. So that gives you a sense of the survey. I'll come back to some other elements of the survey a bit later. But I want to now explain a bit about our concerns about this excessive capital, because we talk about that a lot. It's something quite hard to explain in a short amount of time, but I'm going to give it a go. But I think, first of all, it's worth noting why it matters. And I think that the first thing to note is that if the capital is too high, the consequence of that for the customer is that the premiums are higher or the charges are higher. It means that there is less optimal long-term investment and or pro-cyclical behavior. It also means that the benefits paid out may be lower, or simply that there are fewer products available because we cannot provide products at a reasonable cost, at reasonable capital to our customers. Now, a great deal of effort goes into, it does go and should go into ensuring companies have enough capital. But a lot of effort also needs to go into making sure that companies are not burdened with too much capital relative to the actual risks. So, now let me move on to an explanation of the causes of our concerns around excess capital. And there are basically three that I'll try to explain. The first one is that the liabilities can be exaggerated for certain long-term products. And that comes about because of two key elements that are worth mentioning. One of them is that we're often discounting very close to risk-free rates. And for us, that doesn't represent the correct balance with the total business model that we have. We have the matching adjustment, which can address this in some cases, but it only applies to about 15% of the liabilities of the industry. The rest are using the volatility adjustment, and the volatility adjustment in the last year or so has been ranging between 1 and 10 basis points, so leaving us very close to risk-free rates. We also have the risk margin, and obviously that's been a center of discussion around the EIOPA advice, and a lot of work has gone into that over recent months and years. But those two together can result in an exaggeration of the liabilities. In addition to that, we have then the second part, which is the regulatory solvency capital, or the SCR. Here, it's possible to exaggerate because in many cases, or most cases, the capital is based on a short-term, almost trading-like calibration, not a long-term risk. And the two are basically very different. and Solvency II needs to recognize that. And that means that in some cases the capital is going to be excessive. And finally, the whole system is quite volatile, and that volatility leads companies to want to hold, to need to hold, at their own discretion, significant buffers. And those buffers add to the total burden of the industry as well. So that leads us to artificial volatility because the link between assets and liabilities are not fully recognized. So overall, that leads us in total to excessive capital requirements, which can and does affect the design and availability and investment mix behind the products. And I'll give you a little bit of an example in a moment. So we wanted to bring some of that to life by using some case studies and some analysis that may help explain those concerns and how how much difference it can make taking a long-term or short-term view. And I think the underlying message we're giving here is that there is a difference between long and short-term, and that needs to be recognized and captured by Solvency II in a better way than it does currently. So in order to, the first case study looks at a particular risk and a capital requirements and looks at how much difference a long and short-term view can make. So we looked at 100 years of market data, and we started looking at a one-year trading type view, which is the similar approach Solvency II takes. So it's basically, the idea here is that like a trader who could be forced to sell the entire portfolio after a worst case fall, a one-year price fall. And if you do that on the back data, you get to a calibration of a 1 in 200 event of about 43%, which is very much in line with Solvency II. And if indeed we're always doing that, taking risk in that way, this would be the right calibration. However, when you take a longer-term perspective and recognize, for example, the power of the impact of dividends, dividends accumulate over the longer term and offset capital losses. And that alone makes a difference. So if we just expand from 1 year to 10 year, even if we take a 1 year calibration view, this would actually reduce the capital to something like 26%, or the value at risk to 26%. If we then go further and look at how insurers often work in practice and recognize that in reality, for many with profit-sharing products, insurers are pooling and smoothing risk over individuals and over time, we see even a different picture. And in fact, based on the data here, and we used a very simple smoothing rule of just assuming that the company pays out the average of the last 5 years rather than the actual, for a 10-year product, rather than the actual particular 10-year, and that thereby smoothing the peaks and troughs, including during the 1930s and every other crash we've had. And there we see there was no single period where that particular portfolio would have actually made a loss. Now, we're not saying that capital is not needed, but we are saying there is a difference between short and long term, and we need to put more effort in to understanding that and finding a way to represent that better in Solvency II. The other example I wanted to give is looking at a particular long-term product. Now, often when assessing Solvency II, we look at the aggregate. We look at a total company, we look at even the total country or the whole industry, and the capital ratios are very good. And that's because the industry, as I mentioned before, was and always has been very well capitalized. However, very little analysis seems to be done by looking at particular products and how the measurements affect those products, and therefore can help explain why we're seeing some of the behavior from companies about moving away from these sort of products. And we need to do this to make sure we're designing and calibrating the framework correctly and understanding the impacts. So we decided to look at a simplified long-term product, and we made some basic assumptions which are listed here. Applying those assumptions, we end up with this picture for this particular product. And using the similar sort of approach we used before in the explanation for the 3 causes, we start at the bottom with the impact of discounting close to risk-free. And basically, if you give a guarantee higher than the current risk-free rate, you automatically end up with a negative own funds. Added to that is the risk margin, and both of these need to be funded by the shareholder at the beginning when the product is launched. So this is another form of capital that needs to be injected into that particular business. And then, of course, we have the solvency capital requirements on top of that. And then the volatility buffer we talked about before. If we aggregate all these, our analysis indicates we're getting to very high levels of capital. Now, some of that capital runs off quite quickly. Operating risk, for example, some of it can run off within a year quite quickly. But other capital can stay. And all of that capital needs to be rewarded and paid for. And that's where we have the problem, that if the capital is too high, we cannot design products which work for the customer. And that also explains why and if the capital is too high, we end up with the unintended consequences we saw before, with higher charges, lower benefits, or as mentioned in the anecdotes, a potential move away from some of the businesses. If we then put this in perspective, just to remind you what Solvency I would have done, it would have been much, much less, and that's why we see a big impact. Now, of course, that's not saying that Solvency I was right, and we know that we need to move towards a risk-based system, but I think what we need to do is really make sure that we're measuring the risks in the right way for these products as well as all other products. And if by doing that, we can avoid a situation where we have a shift from insurers taking risk to pushing the risk onto the customers, because that's the capital-light products that work in the regulatory environment. So obviously further work is needed on this, and we'll be doing further work. We'll welcome input from all sorts of sources, and we hope that, and we've been trying to get academics interested in this, and of course we will be engaging with various types of analysis with supervisors and regulators. We need to examine ways to make improvements to the VA, the MA, the dynamic VA, country adjustments. All of these things need to be looked at. The risk margin, of course, the SCR, and we need to test this for different products and different market conditions. So that leads me towards the end of the presentation, and we see that we're back with our journey that isn't over and the reviews. And if we look ahead to the impact, we think that making the right changes really can make a difference, and that's something we also asked in our survey. We asked if the European Commission's action so far had an impact, or the ones that are in process are expected to have an impact. And we got some positive answers. So a significant number of respondents, and this hasn't been filtered for internal model, not internal model, so this was the overall results, is that particularly on infrastructure, many said this would have a positive impact on their investments, unrated debt work, the unlisted equity, securitization. I think the only one that didn't appear to have a particular strong impact was the LTIFs, which I must say the industry had warned that may not be quite as successful as we all wanted. One other question we asked is what would happen if we improve the calibrations for equity? And there was a significant respondent said this would also make an impact. So that brings us to the solutions. And as we have mentioned, Michaela mentioned, there are reviews which were very wisely built into Solvency II, because there was no way something as big and ambitious could be got right first time. So these reviews allow us to make improvements and have Solvency II reach its potential. So we've already seen some efforts through the Capital Markets Union, and as I've just indicated, we think that will have a beneficial effect, although on a very small part of our total portfolio. The 2018 review gives us another chance to add to those improvements. We particularly believe that listed equity should also be tackled with more appropriate calibrations, as well as the unrated debt and the unlisted equity that's already in place, in train. The risk margin, the cost of capital, we believe should be lowered. And the simplifications and inconsistencies and flaws that are in the process of being discussed and are based on, much of which can be based on EIOPA's proposals, can be very useful. And then, of course, we have the 2020 review where we can complete the journey. We can look at the other long-term investments, corporate bonds, property, etc., and make sure they too have long-term calibrations as well as short-term ones. We can look more holistically at the risk margin, the design as well as the cost of capital and its general purpose. We can, of course, look at discount rates, and in particular making sure that this really works across all European business. And we can finish the process of streamlining and of making proportionality work, as well as addressing more of the technical flaws. So that wraps up my presentation, which I hope will set the scene a little bit, but I know we have plenty of things to talk about, so now we'll move over to the panel, and I'll invite the panelists to the stage.